Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. Make sure to hit subscribe. We're going to get into a topic that really doesn't get the attention it deserves, which is, are there things that boards of directors of companies do which have the risk of hurting the returns to investors? Boards of directors do not get the attention they deserve. We all have our favorite CEO, or maybe our CEO that we love to hate. CEOs are celebrities. Boards of directors kind of, disappear into the background. Except boards are in charge of CEOs. So boards are arguably more important than CEOs, or at least they're very important because they're the ones who determine who the CEO is. Or isn't. They're the ones who set the compensation for the CEO, hiring and firing of CEOs, setting the plan. They're very important, but people don't pay a lot of attention to them. Well, we're going to pay some attention to them. So let's specifically look at an issue here, which is, one might call it cronyism. Specifically, are there transactions with related parties? What does that mean? A related party is somebody who has something to do with the business or the people managing the business. They might actually be a related party, like a brother. I think, didn't Elon Musk have his brother on the board of one of his companies? Or they might be somebody who's on your board of directors, but there's some side business deal going on, either at the company or not at the company. Example would be, let's say you've got somebody who's on the board of directors and he owns a janitorial service. And that janitorial service has a contract with the company. Well, as a member of the board of directors, he's supposed to be over the CEO. But as a vendor doing business with the company, he's kind of under the CEO. Or even if it's not the CEO quite making the decision or it's vetted, he still depends on that company and its management for part of his livelihood. Can he really be objective? It's at least a question that we ought to look at, and it is a concern. Okay, so let's look at those who are flagged for this and those who are not. Related party transactions, cronyism here. Non-related party transactions, no cronyism, or at least none of this kind of cronyism here. And this is the performance, how well the investment in that company does the year after. Why is it the year after? Because you don't know the future. You don't know whether there'll be related party transactions next year. You know at the beginning of the year that there were related party transactions, or there weren't. And then you invest, and then this tells you how well you did that year. So you're not able to see into the future. You know a risk factor at the beginning, and then this tells you what effect it had afterwards. And what we see here is that those who are flagged for this, those who have this problem, have significantly lower returns in the subsequent year. By the way, you might notice these numbers are kind of high. The data that is available happens to be a time when the stock market was doing well. So these are going to be high numbers. So what we see here is, at least in this particular case, the function of the board matters, at least in the past. The future, maybe this will work, maybe it won't. All you have is knowledge of the past, and then you try to use that to figure out what might happen in the future. But you don't know for sure. But at least in the past, related party transactions, crony relationships have tended to be associated with lower returns for investors. And just doesn't that make sense for the reasons that we've already talked about? Anyway, I'm Jerry Bowyer. This is the Eagle Investing Network. Make sure to hit subscribe and share this video with somebody who you think might benefit from knowing some of this. Thank you for watching.